40% of US dollars in the world right now were printed in the last year, and we are still printing more. And this isn't exclusive to the United States. The same thing has happened in Canada, the United Kingdom, in Europe, and Australia. The problem is worldwide. Now, a quick look at any history book will tell you how disastrous this can turn out. Just look at Venezuela or Zimbabwe or Weimar Germany and their experiences with money printing, and you'll realise why so many people are absolutely terrified of what's happening. The simple truth is that printing money, quantitative easing, buying bonds, or increasing the money supply in any other method causes inflation, and excessive inflation destroys countries and economies. Now, while there are some people who are paying attention and trying to be cautious, there are also those who have thrown caution to the wind and insist that inflation is a myth and that modern monetary theory now reigns supreme. One of those people is Cathie Wood, CEO of ARK Invest, a hedge fund from New York that has gotten very popular over the last year. She recently put out a video where she talked about our economy, inflation and COVID, and I think it's worth hearing, so I'm going to play some clips from that video for you in a moment. But really quickly, if you're new here, subscribe to the channel. We're putting out loads of videos just like this constantly that you don't want to miss out on.
Now, the monetary policy side is also very interesting. The Fed, despite what everyone seems to be saying, the Fed is already starting to react. Interestingly, the money growth rate, so M2's growth, peaked in February at 27% and is now down to 18% on a year-over-year basis. I haven't seen it below the 20% range in more than a year, I think. So that's very interesting. Anyone worrying about inflation will have to take note of that. 18% is still a very a rapid rate of growth, but the direction has changed unequivocally. The other thing that happened this week is the Fed said it was going to unwind some of the bond ETF and outright bond purchases that it made during the depths of the coronavirus crisis. Now, this is only $60 billion, which is nothing when M2 is at roughly $20 trillion and the monetary base close to $8 trillion. But nonetheless, it's a change in tone. Again, those worried about inflation have to take note.
So, according to Cathie, there is no threat of inflation because we are only increasing the money supplied by 18% a year rather than the previous 27% from last year. I think even Cathie herself realised how ridiculous she sounded as she said that, so she sort of reined herself in and said that maybe we ought to look at the direction that our money printing is going in rather than the figures themselves. But the problem is that even though tapering has technically started, it's happening far too slowly. Our economies are already up and running, we are already getting back to the offices, spending money on coffees and restaurants and burning away our savings. We don't need to be printing 18% more dollars every year. It's far too high and it needs to cut down quickly. We have already seen inflation of 6% over the last year, and that was with the lockdowns which physically stopped people from spending their money and driving inflation. With our worlds opening back up, inflation caused by excessive spending and an overheating economy is a very real prospect, and continuing to print money will only lead to disaster. Cathie also mentioned how the Federal Reserve is planning to slow down bond ETF purchases and actual bond purchases, but again, we have the same problem. We don't need the Fed to slow down, we need it to stop altogether. And Cathie made no mention of mortgage debt and how the Fed is still buying that up by the billions every month, causing the housing bubble to increase exponentially. Now, surprisingly enough, Cathie does go on to talk about our economy as a whole and the government's plans for it, and there is some actual good news where I agree with Cathie entirely.
There was a Harris poll taken in the last week or so of 10 Democrat swing states. It was a Harris X poll, and it was for a group called No Labels. It was taken during May 18th to May 23rd. Some of the results were very interesting, and I think are factoring into the way that the Biden administration is beginning to think about both spending and taxes. The bottom line is spending will likely not be as high as President Biden's proposals, and taxes, surprisingly, we think are starting to move back into a capital-friendly stance. So as far as the results of the poll, let's see, strong majorities in all 10 districts say taxes overall should either be lowered or kept the same, while between 61 and 71% in each district opposed raising federal taxes. By majorities ranging from 66 to 72%, voters in all 10 states opposed raising capital gains taxes, while between 64 and 70% in each district opposed raising taxes by $1.8 billion. So that's very interesting. These are 10 swing states for the Democrats. Those are the results. And it does seem as though the talk around spending is starting to sound a little bit like there may be something more bipartisan than otherwise might have been the case. And it does seem like the tax talk is now more around corporate taxes, but not corporate taxes going up, tax rates going up from 21 to 28%, but now this minimum corporate tax at 15%. So every corporation who has not been paying taxes pays at least 15%. That seems to be the direction in collaboration with the European Union, or the G7, I believe. So that's very interesting. This means we may not see a capital gains tax rate increase, which would be phenomenal, and I do believe the market is starting to respond to this, nor a corporate tax rate increase, certainly not to 28%, maybe a few percentage points, but even that seems to be diminishing in probability. So I would say on the fiscal policy side of the equation, relative to our fears, certainly, about capital unfriendly policies, and certainly policies unfriendly to innovation, we are beginning to feel a lot better.
So basically, the Biden administration has been looking at a bunch of polls in some swing states where the Democrats really need to pay attention if they want to remain in power, and they're seeing that their plans aren't actually popular. Most people oppose a raise in tax rates, and most people oppose the huge spending plans that Biden is so keen of. So it appears as though the Biden administration is going to rein in their plans and be a bit more pragmatic, which is great news. There's also the introduction of the worldwide minimum corporate tax rate of 15% that the G7 has agreed to, and that will prevent countries like Ireland from undercutting the rest of the world and will actually do all of us some good. Cathie is absolutely right when she says that this is good news and good for the markets and good for us, and it's great to see and hear something positive for a change. If you're new to the channel and you enjoyed this video, then subscribe. If you want to help spread the word, then like the video and leave a comment, and YouTube will do its part by pushing this video out to more people just like you. There's far more content just like this coming out soon. I've also recently started working with Webull, a brokerage that is growing like crazy, and there's a link in the description which will give you 2 free stocks worth up to $300 if you sign up through there, so be sure to check that out too. Thanks for watching, until next time.